I always love it when we have guests out of Beijing because it really gives us a glimpse of what sentiment is really like on the ground. It's hard to see really from the outside sometimes. So give us your sense. How are things feeling right now on the mainland?
Yeah, thanks, David. Basically, you can see China's market has a rocky start so far. But yesterday, you can see China's policy has shown a very strong support to stabilize growth. You can see the monthly incremental bank loan has reached almost 4 trillion, and the total social financing also reached 6.2 trillion RMB in January. So I think that was in line with the policy message that delivered in the Central Economic Conference later last year. China is trying to stabilize growth and inject liquidity to the economy. I think given all this policy support, China's growth will gradually stabilize later. And I think that will improve the market sentiment. At the beginning, it seems a little bit, the sentiment seems a little bit weak right now.
Okay, well, I mean, approaching that anyway, we've already seen financials start to really outperform. Infrastructure stocks have also done very, very well. What are your sector picks as far as that's concerned?
We believe growth stabilization will be the major trading scene, especially for the first half of this year, when China began to introducing more policy to stabilize growth. So as you mentioned, the financial infrastructure, building, home appliance, home furnitures, all these macro-related, policy-driven related sectors will outperform the market, especially in the first half of this year.
And how does that play out in the property space too, Hanfeng? Because this report that we have about AMCs are now told to step in to help out these distressed developers. Does that raise more concerns for you for the sector? Perhaps that we are seeing a little bit more light at the end of the tunnel.
We are actually technically more positive on the property sector in the short term, especially we see the China's policy in the property sector began to be fine-tuned since later last year. And as you mentioned, China introducing more policy to stabilize the property market. And especially you can see after more than a year of declining, the sector is right now is at an extremely low valuation and the sentiment are very, very low. And at the same time, you can see policies gradually become more active. Including the easings of the monetary condition and borrowing by the property developers, and also the easing some of the housing restrictions in some local markets. And then combining all these factors together, we believe that it will improve the outlook of the property sector. So that's why we are tactically positive on the property sector right now.
Yeah, and in terms of where you deploy your capital, whether it's A or H shares, it seems like you're very much in this H share camp now and thinking that they're going to outperform onshore. Why the case for that? And what do you see as that kind of trigger for H shares to actually take off?
Okay, so basically, the H shares has underperformed the A shares for consecutively 3 years. And that's why that's one of the reasons why we turned more positive on H shares later last year. And another reason behind this is look at the absolute valuation. The H share right now, after 3 years of underperformance, the valuation has reached the lower bound of the historical range. And if you talk to investors, I think most of the investors, not just from the mainland, but also investors from the rest of the world, they are kind of very negative on the H share market. So that means the position in this market are very light. So given the relatively low valuation, given the light position, and also China began to introduce policies to support China's growth, which will improve the China's growth outlook probably later this year. I think that provide catalyst to the H share market.